Chapter 1 Introduction to Assurance.
The learning objectives of the chapter are: 1. The concept of audit and other assurance engagements. 2. Limitations of external audits.
What is assurance? An assurance engagement is an engagement in which a practitioner obtains sufficient appropriate evidence in order to express a conclusion designed to enhance the degree of confidence of the intended users other than the responsible party about the outcome of the evaluation or measurement of a subject matter against criteria. Giving assurance means offering an opinion about specific information so the users of that information are able to make confident decisions knowing that the risk of the information being incorrect is reduced. There are 5 elements of an assurance engagement. 1. A 3-party relationship involving a practitioner, auditor, a responsible party, directors, and intended users, shareholders. 2. Appropriate subject matter, financial statements. 3. Suitable criteria, financial reporting framework. 4. Sufficient appropriate evidence for the basis of the opinion conclusion. 5. A written assurance report in the form appropriate to a reasonable assurance engagement or a limited assurance engagement. Types of assurance engagement. 2 types of assurance engagement are permitted. 1. Reasonable. 2. Limited. In reasonable assurance engagements, the practitioner gathers sufficient appropriate evidence to be able to draw reasonable conclusions, concludes that the subject matter conforms in all material respects with identified suitable criteria, gives a positively worded assurance opinion, gives a high level of assurance, confidence, performs very thorough procedures to obtain sufficient appropriate evidence, tests of controls and substantive procedures. In our opinion, the financial statements give a true and fair view of, or present fairly, in all material respects, the financial position of ACCA's company as at date, and of its financial performance and its cash flows for the year then ended in accordance with international financial reporting standards. While in limited assurance engagement the practitioner gathers sufficient appropriate evidence to be able to draw limited conclusions, concludes that the subject matter, with respect to identified suitable criteria, is plausible in the circumstances, gives a negatively worded assurance conclusion, gives a moderate to a lower level of assurance than that of an audit, performs significantly fewer procedures, mainly inquiries and analytical procedures. Nothing has come to our attention that causes us to believe that the financial statements of ACCA's company as of date are not prepared, in all material respects, in accordance with an applicable financial reporting framework. The confidence inspired by a reasonable assurance report is designed to be greater than that inspired by a limited assurance report. Therefore, there are more regulations or standards governing a reasonable assurance assignment. The procedures carried out in a reasonable assurance assignment will be more thorough. The evidence gathered will need to be of a higher quality. External audit engagement. An external audit is an example of a reasonable assurance engagement. Its purpose is to enhance the degree of confidence of intended users in financial statements. This is achieved by the auditor expressing an opinion on whether the financial statements give a true and fair view, or present fairly in all material respects, are prepared, in all material respects, in accordance with an applicable financial reporting framework. The financial reporting framework to be applied will vary from country to country. In audit and assurance, it is assumed that international financial reporting standards are the basis for preparing the financial statements. True and fair, true, factually correct information which conforms with accounting standards and relevant legislation, and agrees with the underlying records. Fair, clear, impartial and unbiased information which reflects the commercial substance of the transactions of the entity. Objectives of the auditor. The objectives of an auditor are to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error. Express an opinion on whether the financial statements are prepared, in all material respects, in accordance with an applicable financial reporting framework. Report on the financial statements, and communicate as required by ISAs, in accordance with the auditor's findings. Need for external audit. Shareholders provide the finance for a company and may or may not be involved in the day-to-day running of the company. Directors manage the company on behalf of the shareholders in order to achieve the objectives of that company, normally the maximization of shareholder wealth. The directors must prepare financial statements to provide information on performance and financial position to the shareholders. The directors have various incentives to manipulate the financial statements and show a different level of performance. Hence the need for an independent review of the financial statements to ensure they give a true and fair view, the external audit. In most developed countries, publicly quoted companies and large companies are required by law to produce annual financial statements and have them audited by an external auditor. Companies that are not required to have a statutory audit may choose to have an external audit because the company's shareholders or other influential stakeholders want one and because of the benefits of an audit. Benefits of an audit. Higher quality information which is more reliable, improving the reputation of the market. Independent scrutiny and verification may be valuable to management. Reduces the risk of management bias, fraud and error by acting as a deterrent. An audit may also detect bias, fraud and error. Enhances the credibility of the financial statements, for example for tax authorities or lenders. Deficiencies in the internal control system may be highlighted by the auditor. Expectation gap. Some users incorrectly believe that an audit provides absolute assurance, that the audit opinion is a guarantee the financial statements are correct. This and other misconceptions about the role of an auditor are referred to as the expectation gap. Examples of the expectation gap: a belief that auditors test all transactions and balances, but they test on a sample basis. A belief that auditors are required to detect all fraud, but auditors are required to provide reasonable assurance that the financial statements are free from material misstatement, which may be caused by fraud. A belief that auditors are responsible for preparing the financial statements, but this is the responsibility of management. Limitations of an audit. Financial statements include subjective estimates and other judgmental matters. Internal controls may be relied on which have their own inherent limitations. Representations from management may have to be relied upon as the only source of evidence in some areas. Evidence is often persuasive, not conclusive. Do not test all transactions and balances. Auditors test on a sample basis. Auditors provide reasonable assurance, which is not absolute assurance. The limitations of an audit mean that it is not possible to provide a 100% guarantee. Review engagement. A review engagement is an example of a limited assurance engagement. A company which is not legally required to have an audit may choose to have a review of their financial statements instead. The review will still provide some assurance to users, but is likely to cost less and be less disruptive than an audit. The procedures will mainly focus on analytical procedures and inquiries of management. In particular, no tests of controls will be performed. As only limited assurance is being expressed, the work does not need to be as in-depth as for an audit. The objective of a review of financial statements is to enable an auditor to state whether, on the basis of procedures which do not provide all the evidence required in an audit, anything has come to the auditor's attention that causes the auditor to believe that the financial statements are not prepared in accordance with the applicable financial reporting framework.
Thank you. Your appreciations will expedite our work.